Question 5. Answer in brief. 4 marks each. 1. What is public deposit? Answer. According to Section 231 of the Companies Act 2013, deposit includes any receipt of money, by way of deposit, or loan, or in any other form, by a company, but does not include such categories of amount as may be prescribed, in consultation with the Reserve Bank of India. Public deposits are governed by Rule 1C of Companies, Acceptance of Deposits, Rules 2014, according to which deposit does not include any amount received or raised. 1. From central government or a state government. 2. As loan from any banking company. 3. From foreign government or international banks. 4. By a company from any other company. 5. By issuing commercial paper. 6. By issue of bonds. 7. In trust, and 8. By way of subscription to any shares or debentures. Public deposit is an important source of short-term financing for a company. Under this method, company invites general public to deposit their savings for varied period. Deposits are either secured or unsecured loans offered by public to the company. Companies can receive public deposits for different periods, ranging from 6 months to 36 months. Rates of interest offered by companies on deposits are higher than those offered by banks. The company issues fixed deposit receipt to the depositor. Deposit receipt is an acknowledgement of debt by the company. It contains the terms of deposit. 2. What is Global Depository Receipt? Answer. Due to economic reforms and adoption of globalization, an Indian company's shares can now be listed and traded on a foreign stock exchange, like New York Stock Exchange, NYSE, or National Association of Securities Dealer Automated Quotation, NASDAQ. The policies of foreign stock exchanges are different than those of Indian stock exchanges. Hence, company is required to comply with policies of those stock exchanges, which are very complicated and rigid. In order to overcome this problem, the companies get listed indirectly using American Depository Receipt (ADR) and Global Depository Receipt (GDR). ADRs and GDRs help companies to tap foreign funds and increase their shareholding base. Both ADR and GDR are depository receipts. The only difference between the two is the location where they are traded. If the depository receipt is traded in USA, it is termed as American Depository Receipt (ADR), and if the depository receipt is traded in a country other than USA, it is termed as Global Depository Receipt (GDR). GDRs are listed on a stock exchange outside the US. Companies can approach depository banks of various countries and make an arrangement with them. The depository banks issue GDRs to investors against Indian companies' shares. GDR is a negotiable instrument all over the world. GDRs are traded on London Stock Exchange, Luxembourg Stock Exchange, Nasdaq Dubai, Singapore Stock Exchange, and Hong Kong Stock Exchange. 3. What is trade credit? Answer. A trade credit is an arrangement where a customer can purchase goods on account without paying cash, paying the supplier at a later date. Trade credit is a helpful tool for growing businesses when favorable terms are agreed with a supplier. Manufacturers, wholesalers, and suppliers of goods or raw materials act as trade creditors for other business organizations. They extend credit to increase their sales, and also because of custom that has been followed over time. Trade credit is not a cash loan. It can be obtained without signing any debt instrument. Therefore, it is granted to those customers who have reasonable amount of financial standing and goodwill. Small retailers rely on trade credit from their suppliers to a great extent. The terms of credit are not rigid. Suppliers may allow 30 days or more for payment of bill and may offer discount in bills if the same are settled within a short period, say 10 or 15 days. Advantages of trade credit. 1. It is the cheapest and easiest method of raising short-term finance. 2. It does not require any formal or written agreement. 3. It is readily available at any time. 4. It is free of cost source of financing, as there is no need to pay any interest. 5. The terms of credit are not rigid. Disadvantages of trade credit. 1. There is possible loss of early payment discount. 2. Failure to comply with the conditions may lead to the loss of a supplier. 3. Cash customers may ask for favorable trade credit. 4. It cannot be used by all businesses, such as online traders. 5. There is no guarantee of cash flow, as customers may pay late. 4. What are the schemes of disbursement of credit by bank? Answer. The various innovative schemes for disbursement of credit by bank are as under. 1. Overdraft. This facility is given to companies having current account with bank. It is provided for a short-term period, whereby company is permitted to withdraw more than the balance in the current account up to the credit limit sanctioned by the bank. Within this sanctioned limit, any number of drawings are permitted and repayments can be made as and when required. No separate account is maintained and entries are shown in current account itself. Interest is charged on actual amount withdrawn. 2. Cash credit. In this case, a separate cash credit account is opened in the name of the customer and it is credited with the advance sanctioned. The customer can withdraw money from this account as and when required. Cash credit facility is given against pledge or hypothecation of goods or any other alternative security. Interest is charged only on the actual amount withdrawn and not on the total amount sanctioned. 3. Cash loans. A fixed amount sanctioned for a definite period of time is called loan. Commercial banks provide loans to businessmen and others. The borrower has the option to withdraw the entire amount of loan at one time or in installments. Interest is charged by the bank on the actual balance outstanding. 4. Discounting bills of exchange. The drawer or beneficiary of a bill of exchange can discount the bill with bank and obtain an advance. This is nothing but selling the bill to the bank. Banks make payment of the amount after deducting certain amount of discount. On the due date, the bank will recover the amount from the drawee, and in case it is not paid, the bank recovers the same from the borrower. 5. State the features of bonds. Answer. A bond is a loan, and therefore, bondholders are creditors of the company. All bonds have maturity date and carry fixed rate of interest. The interest is payable at fixed interval or on maturity of bonds. The term bond is normally used when debt funds are raised by government or public corporations, including banks and financial institutions. The examples of government bonds are Rural Electrification Bond, National Highway Bonds, etc. The features of bonds are as under. 1. Nature of finance. Bond provides long-term debt finance. The bonds are issued for longer period, that is, for 5 years, 10 years, 25 years, 50 years, etc. 2. Status of bondholder. The bondholders are creditors of the company, and hence, they are not entitled to participate in general meeting. They do not enjoy voting rights, and cannot participate in the management of the company. 3. Return on bonds. The return on bonds is in the form of fixed rate of interest. The interest is payable either at regular interval or on the maturity of the bond. 4. Repayment. Bonds have specific maturity date. On the maturity date, principal amount is repaid, along with interest, if not paid, at regular intervals.